Hi, everyone. You got Rod Crandall here, Chief Integration Officer at USAdvisors Insurance. Appreciate you joining us here today. This is one of a monthly series that we call our Coach's Corner. So once a month, you get my smiling face, and sometimes we have special guests like today. So in a little while, we have Rob Johnson from Lincoln MoneyGuard joining us today. He's going to give us some really great updates on what Lincoln is doing and how they've gotten much more competitive in today's environment and made some very good enhancements. So you're going to want to hear that as well. So today's topic is really around the best tips for long-term care planning. And so you're going to hear a lot today from both me and Rob on how to effectively have the right kind of conversation and what kind of solutions might be out there today. If you tuned into these before, you know that US Advisors really sells, if you will, the intentional integration of insurance inside of a wealth advisor's practice. And if we're going to do this intentionally, what we need to do is really need to identify the people that we need to have a conversation with. We need to position or have that conversation with them. Then we ultimately need to pair them with the right solution or product or design to make something happen. And so in the time we have today, a little under an hour, we're going to hopefully be able to help you understand how to do that a little bit better. And we're going to highlight one of our great product partners, Lincoln MoneyGuard, as I indicated. And with that, we're going to get started here. So, if we're going to do this, we got to figure out who are we going to talk to, and then what are we going to talk to them about? And the net result is helping them create a plan for their care. See, long-term care insurance in some form or fashion is not the plan. It's what pays for the plan. Okay, so many people like to jump into the product, and I'm suggesting you do not do that. Right? Nobody really wants what insurance is. They want what insurance does. And long-term care insurance is really solidifying the retirement plan. It's really providing retirement portfolio protection for our clients. Right? What is the effect that would happen on the portfolio if we had to double dip because somebody needed care? Right? And so if we have the right kind of conversation, then we can create a good plan. And then that plan says, well, how are we going to fund that plan? And then we can get into the products. But do not lead with products if I can offer you one strong tip. It's my belief that people do not want product. I don't want product specifically. I want what it does for me. And what it generally does for me is provide funding at the exact time that I need it. And what it really does is it makes sure that my financial plan, my estate plan, my legacy plan, the promises to my family are fulfilled if we do this thing right. So if we're going to talk about who we're going to talk to, broadly speaking, I think there's three different types of clients. You have clients that are Medicaid likely, those that are in the middle class, and those that are wealthy. Okay, so why do I break them down this way? Well, if your clients are Medicaid likely, what that generally means is they're lower income and asset type clients. Don't mean to be rude by saying that. What I do mean to say is that those people probably are not your clients. To the extent that they're likely to go on the Medicaid program, that means that they have little to no assets to protect. So for the purpose of this presentation, we're largely going to ignore that group. Then we have two other groups, the middle class. Well, how's that defined? I don't know. It's big though, right? They have some assets, some income. And then you have the wealthy. Why am I separating the wealthy from the middle class? Well, I think because a lot of times I've heard from advisors and I've heard from wealthy individuals that they don't need that long-term care insurance. To which I say, I agree with you. You don't need it, but you may want it. And why might you want it? Well, first of all, paying for your own care dollar for dollar out of your pocket is still the least effective way to pay for care, number one. And number two, when you really drill down and ask, okay, well, you'll pay for it yourself, but what bucket of money might you use to pay for this? What you'll rarely find is that the highest yielding bucket is what they're going to use. They're going to use something that is maybe in their bond portfolio or in their savings account, or maybe even in their checking account or in CDs, which are very low interest rate type products, right? And so a lot of what we can do is reposition dollars for affluent individuals. And by the way, the Lincoln MoneyGuard is perfect for that repositioning of dollars and getting tremendous leverage. Okay, so when you think about this, start thinking about who do you know that's in the middle class or wealthy that we need to have a conversation with, right? Now, at the end of the day, what kind of products do we ultimately deal with when we steward through this? You really have traditional long-term care, you've got hybrid policies, and then you've got life insurance with long-term care chronic illness riders. And there's also some products out there that are annuity products that double or perhaps triple for long-term care purposes. So again, we're not going to focus much on product today outside of the Lincoln MoneyGuard. But what I do want you to understand is I do think that it's important to bring more than one solution to your client once you've walked them through this type of conversation, because that helps them compare and contrast one design over another. And I have a fundamental belief that clients have a very hard time indicating exactly what they want, but they can very quickly decide what they don't want. And so when you start comparing traditional long-term care to maybe the Lincoln MoneyGuard program, to maybe a life insurance with a long-term care rider, there's going to be pros and cons. And you start walking through that, people become educated, and then they can consider what we're talking about. So some of my favorite words are education and consideration. If we educate our clients through an appropriate planning conversation, then they can really consider what this important planning item means to them. That's fundamentally different than asking if they want to buy insurance. And of course, the answer there is almost always no. But they do want to take care of their family. They do want to provide a legacy. They do want to protect their retirement income. And so that's the level of conversation we need to have with them in order to make this happen. Now, by the way, if you like what you're hearing here, but you're uncomfortable having these conversations yourself, you could consider utilizing me to do joint work with you. That's a good bulk of what I do at US Advisors, is doing joint work with advisors to be able to have these conversations and actually follow everything through underwriting. Right. So to the extent that you'd like me to partner with you, it'd be great if you reached out to me and we could determine how to do that. What are you going to do? What am I going to do? How are we going to split? But suffice it to say, I have done joint work with over 200 advisors in the last 17, maybe 18 years. And I've been in business here now coming up on, 23 years in September, actually. So if we're going to talk about this, where are we going to talk about this, right? Well, generally speaking, I think there's 3 good entry points for this conversation. One is in the annual review. If you're like so many advisors, the annual review is an hour long, and you might be talking to the client about their family and their vacations for 50 minutes, showing them product performance the last 10 minutes and telling them, I'll see you next quarter, or I'll see you next year. Well, that may be a perfect opportunity to congratulate them on their portfolio and the financial plan, and then indicate, do you want to talk about what could possibly go wrong? Would you like me to stress test your portfolio against a long-term care event? Right? That could be something that we could consider. Second is personal experience. Anytime you're talking to anybody about this, I would suggest you ask them what their experience has been. What I find is if they have experience in this area, it's a night and day different conversation than someone that doesn't. And so to the extent someone has personal experience, we can ask, what was that like for you? Right? And what was it like for that person and that family? And how much are you aware of the math? How much are you aware of the emotions, right? I have a belief that if a long-term care event occurs with our clients, it's going to be the worst of times, effectively, right? It's going to be a terrible time. But if our math isn't right and we have an emotional issue at the same time, to me, that's like putting a magnifying glass in the sun and watching your yard just go up in flames, right? So we want to make sure that we're helping clients with this very important planning item, okay? I'm not sure if I feel like, okay, good. I thought I might have lost connectivity. There may be some internet issues going on here today. Then finally is the longevity. If you're a financial planner, you're likely running financial plans out to age 90 or 95. And if you're doing that, by definition, you and the clients might believe that clients could live a long life. And if that's the case, we need to consider that living a long life could increase the risk that we need long-term care. Right? And I don't know if you've thought about it, but life insurance and long-term care are really polar opposites of each other. Right? Life insurance is effectively protecting us if we die too young, and long-term care insurance is protecting us, quote, if we live too long. And the real key there is, to the extent that I live a long life, the likelihood that I need help living that long life increases. And that's where we can talk about this longevity risk. And by the way, anytime that we can tie this conversation directly into the financial plan, the better, because that's what we're doing, is we're making the financial plan more stronger. We're making it stronger, right? And that's really what this is. It isn't about insurance. It's about making sure that our clients' goals, dreams, and desires come to fruition, right? So inside of that, we always talk about risk, and you've heard me talk about risk. But the reality is that it's not really the risk, it's the consequences, right? What are the consequences on the retirement portfolio? What are the consequences for the family mathematically and emotionally, right? So we need to talk about that. We need to help clients understand that what we're talking about when we say long-term care, right? When and where does long-term care begin? Some people have the perception that you must be flat on your back in a nursing home to need long-term care, and that's just not the case. I think Rob's going to share some statistics that indicate that almost nobody is in long-term or in nursing homes today collecting benefits. They're elsewhere, right? I believe the nursing home is the last place we go. It's not the first place, it's the last place when we can't do anything else. And we need to make sure that clients understand that, right? And then understand that there's more than one risk. It's not just mathematical, it's emotional, it's physical, right? We can ask them, would you like your kids to be able to coordinate your care, or do you want your kids to provide your care, right? So then it's back into these better conversations, which the net result is that we want to have some sort of plan, right? We want to know where do you want your plan, where do you want your care to be received? Almost invariably, when you ask that question, people would prefer to stay home, right? Okay, well, if you can stay home, who would you want to physically provide that care? Well, my daughter would probably take care of that. I understand that she would, but do you want her to physically provide that care, or would you prefer that she coordinates that care, right? There's two differences there. By the way, I've heard a client of mine indicate that they have long-term care insurance in place because it gives them a permission slip for their children to get them the care that they need. And I actually believe that, right? I don't want any of my clients to go on claim unless they deserve to be on claim, right? I don't want anyone to have this kind of terrible situation in their life. But to the extent that they're eligible for a claim, I want them to get their money, and I want them to get their money right now, right? And so there may be a prevalence in some family to hold off care because care can be pretty expensive, right? Absent the permission slip that says, no, we already have a plan for this and we already have a funding vehicle for this. So let's turn on the funding vehicle. So we have to figure out who or what's going to pay for the plan, right? So again, if you need care, where's the money going to come from, right? Long-term care insurance, if it's retirement portfolio protection, another way to think about that is long-term care insurance produces an additional income effectively at exactly the time you need it most. So your cost of care went up because you need some sort of care. Well, we have a policy that's going to pay perhaps a monthly benefit, right? And we're going to hear a little bit more about some great updates at Lincoln MoneyGuard with regard to how you can receive your payments. And then I've said it before, but insurance isn't the plan, insurance pays for the plan. And so that's really the context that we're dealing with. At the very end of the day, if you walk clients through this, what you hear is that they want to have a plan that allows them to stay safe in the comfort of their own home. And they want to make sure that it protects their family, right? Physically, emotionally, and mathematically by, again, allowing them to supervise the care, not to provide the care, right? And there's a big difference between those two. So at the end of the day, when you think about what funds long-term care, there's really only a few things. You can have Medicare fund it, but that's not really long-term care, that's short-term care. You're talking about 100 days, you have many hoops that you have to jump through, and there's a maximum of what can be paid. The majority of our clients, their financial plan is not going to be ruined if they have 3 months of care they need to pay out of pocket. So again, for our purposes, the Medicare short-term care is almost ignored in the planning. Then you go Medicaid. Well, Medicaid is what? Welfare plan. Right? Well, the welfare plan says that you need to spend down nearly all of your assets in order to qualify to get Medicaid to pay. Well, if we have clients that have assets under management and sometimes hundreds of thousands or millions of dollars, that can end up being a very expensive solution to be able to go on Medicaid in that way. Then you've got self-pay, right? Well, we have a cost. What's it costing us? I don't know. Can your clients cash flow another $4,000 to $10,000 per month? And if so, where are they going to do that from? What asset? What happens if that's in a down market? We're going to want to be redeeming shares in a down market to pay $8,000 a month for mom's care. Maybe not the most ideal plan. Or we can look at long-term care. Okay. I happen to believe that clients do not need to put long-term care in force, but they need to really consider doing so. And my experience says that if clients really consider doing that, what you find is that most people will put some coverage in place. When you have a risk, you can define what that risk is and how you feel about it. And at the end of the day, with any risk, including long-term care risk, retirement portfolio protection risk, all you really have is two choices. You can accept the risk that you have, and keep your money and hope that something doesn't happen. Or you can transfer some of your money, either in the form of paying premiums or maybe repositioning dollars, so that you can transfer some or all of that risk to the insurance company, which will help mitigate the consequences that could occur if we don't do this important planning option, right? And that's what this slide is showing, is the two choices, as I just mentioned, right? And so if we're going to do this and your clients want to take action, please medically pre-screen them. There's a prevalence to just get somebody into underwriting and see what happens. That is definitely not the right practice. You've got to be able to ask your clients questions. It's very, very important. These insurance companies are looking generally pretty extensively, depending on the design, on our clients' health. And so we want to understand that up front so that we can bring them to the right carrier and the right design. So it can be tricky talking about health, but you're putting yourself and the client in a position of disadvantage if you don't pre-screen this. How I generally do it is I ask if they're as healthy as they look and ask if they have any prescriptions. When you ask those two questions, especially the prescriptions, a lot of things will come out. And then I do describe to them the difference between mortality and morbidity. Depending upon what kind of contract we're implementing, we might be underwriting for morbidity, which is the likelihood that I'll become disabled, or we might be underwriting for mortality, which is the likelihood that I might prematurely die, or in some cases, I'm underwriting on both sides, and we need to be aware of that. And by the way, certain health ailments are much bigger deal for someone underwriting for mortality because they're likely to kill you than they are to make you become disabled. And then we have the vice versa. So we definitely want to know what we're getting into, and we do not want to be blind on that basis. So with that, what I want to do is I want to introduce Rob and bring Rob on. I'm going to stop my share so that he can put his share up. And what he's going to do is he's going to walk you through, again, what's going on at Lincoln and what's available with the product enhancements and the like. So Rob, if you're there, go ahead and turn on your camera and share up your screen, and we'll be ready to rumble here.
Great. Thank you so much. I appreciate it.
Yeah,
you need to hand over rights to allow me to share the screen.
Beautiful. How about now? Let's see here. Participants. Yep, here we go. Now you should be good, Rob.
Okay, let's try. There we go. Screen
Beautiful. 2.
Awesome. Hey, appreciate the introduction and the opportunity to visit with all of you today. Great information from Rod here leading up to this. And again, this is not a product dump. We just want to share some of the things that we're doing as the leader in this hybrid space to offer solutions that are really meeting the needs of our clients, their family members. We've made a number of enhancements just this past May, and we'll walk through some of those changes today. But I really just want to add on to what Rod had already mentioned here. This is MoneyGuard. This is just one of a variety of solutions. In this space, there's about 12 carriers that offer these hybrid solutions. There's also a ton of life policies out there with LTC riders, some with chronic illness riders. There's traditional LTC. There's annuities with LTC. There's more options than there's ever been. And there's not one secret one that works great for everybody. MoneyGuard just happens to be, in this space, the #1 seller of these types of solutions. I also just want to add on, he talked about where do we want to receive that care? Just to give you some perspective, this week, in fact, Lincoln MoneyGuard turns 34 years old. And in 34 years, less than 1% of folks have ever surrendered MoneyGuard. But if we look at where our claims are coming in, so we got 34 years of MoneyGuard sales. And when we look at last year, only 7% of our claims were paid to a nursing home. 7.
Wow.
46% last year were paid to individuals who chose to receive that care at home. Another 46% elected to receive their benefits while they're in an assisted living facility. If you're doing the math, and again, I'm not a math major here, that leaves another 1 or 2%. Those claims were paid to adult daycare facilities, for hospice care. So there's a variety of other things, but the vast majority are at home or in assisted living. We're also seeing obviously claims and memory care facilities as well. So let's just continue to dive in here. Talk a little bit about MoneyGuard for those of you that are new to it. How does it work? And our product here across the country, and it's called MoneyGuard Fixed Advantage. If you looked at MoneyGuard in the past, you might have remembered a product named MoneyGuard 2 or MoneyGuard 3. The solution that's available as of May is MoneyGuard Fixed Advantage, available everywhere except California, New York, Virgin Islands, and Guam. But this is the story. I mean, when we think about hybrid solutions, and I've been doing long-term care like Rod for almost 23 years now. And the story about these types of solutions has been this live, quit, die story. And I get it, understanding live, quit, die. I've always liked to position as leverage, legacy, and liquidity. What does this solution, MoneyGuard, offer? Number one, it offers, and you see it on the left-hand side, is that piggy bank, the biggest piggy bank. That's where we're going to take your dollars and we're going to leverage those out of the gate. They're going to get leveraged between 3 and 4 times. Most folks elect to have some type of inflation component on there, an inflation rider, usually 3%. So that leverage bucket, and we'll look at it on the next screen, continues to grow. So that LTC benefit, hopefully it may not totally keep up with the rising costs, but it's going to continue to grow. So you have a meaningful benefit down the road. There's the middle piggy bank. That's a legacy bucket. When we think about long-term care solutions, and LTC solutions have been around since the early 70s, those traditional LTC, which, listen, for the right client, traditional LTC is a good solution. My parents have a traditional LTC, and I'm so thankful they have it. But what's important to know is those types of solutions, if you never need to access the policy, there is no death benefit. With a MoneyGuard type solution and MoneyGuard Fixed Advantage, there's a death benefit if they never need long-term care, at least what they paid in, if not more. That's unique in this space where we're seeing some carriers roll out solutions where that death benefit could be less than what we paid in. We want every client to have that peace of mind that if, hey, I never need extended care, long-term care, my beneficiary is going to get tax-free at least what I paid in. So there's a leverage, legacy. Last piggy bank here is the liquidity bucket. That's it. Hey, what if I ever change my mind? I mentioned before, it happens less than 1% of the time, but we have 2 ROP options. One that says if you ever change your mind, you get back 70% of what you paid in. Why do almost 96% of MoneyGuard applicants go with that option? Because that piggy bank on the left-hand side, the reason we're buying this policy, that leverage bucket for tax-free LTC benefits, is bigger. The second option is option 2. It's a vested ROP option. So you can see on the schedule there, starts at 70%, grades up after 10 years, you can get back 100% of the money you have paid into the policy. But every single MoneyGuard offers these same solutions: leverage, legacy, and liquidity. So I want to look at an option just to see what do the numbers look like. Rob, you said, you know, there's some leverage there. What does the death benefit look like? This is Susan. She's 55. She's in good health. We offer a couples discount as long as that individual is married, even if the spouse is uninsurable or has no desire to purchase this type of coverage, we'll give them a couples discount. The other thing that makes MoneyGuard unique, and it's the only one I'm aware of in this space, we do not have a tobacco rate class. So if you're a smoker, you get the same rate. If you're a married smoker, you get the same rate as a married non-smoker. So really just 2 rate classes: a standard rate for those that are single or widowed, and then a couples rate. This is Susan. She's elected to pay for her MoneyGuard policy. Instead of writing a single check, she elected to pay it over a period of 10 years. Our payment options are anywhere between 1 and 10 years. So you can do a 2-pay, 3-pay, 4-pay, all the way up to 10 years. The other great way to fund this type of solution is identifying cash value, maybe in an old life insurance policy that you can do a 1035 exchange. Almost 30% of the business, and I cover 10 states here at Lincoln, almost 30% of my business comes in some form from a 1035 exchange. So that's a great option if we're looking, how do we fund this? This is Susan. She's selected to pay $10,000 a year for 10 years. what do those benefits look like? If she were to need long-term care at age 85, so last year, our average claim was 83. So you'll see on that basic ROP option, she'd have almost $9,000 a month tax-free. By that time, her bucket of money, we talk about instead of spending a dollar and having a dollar available for long-term care, she put $1 into this policy. Now she has $7 available tax-free for LTC benefits. So she paid in $100,000 over 10 years. Now she has $705,000 of tax-free benefits available to allow those family members to help. As Rod said, we'd much rather supervise that care rather than be the caregiver. I think of it as an employer-employee relationship. I'd always rather be the boss. You could see the $100,000 death benefit, and then we talked about the 70% return of premium. You see the vested amount, a little bit smaller on the monthly benefit, $75.78. About $115,000 less in terms of total pool of money, but still about 6 times leverage for what she paid in. Also, anytime after 10 years, she could get back 100% of what she had paid into the policy. So where does MoneyGuard stack up now? And this is current, these are current pricing. We've seen a number of carriers, including all 3 of these, adjust pricing here during 2022. You can see this is a male age 65 who elected to pay his premium over 10 years with a 3% inflation rider. And we ran each of these with maximum LTC benefits. You could see Lincoln right there for this male, and especially for males, I would say that we're typically right or near the very top in terms of leverage. You can see our monthly benefits almost $6,500 at age 85. Pool of dollars, about $500,000, and then $100,000 death benefit. For females, again, right there, you're going to see similar benefits. There's no magic potion. All of these insurance carriers, whether it's One America or Nationwide or Lincoln or Securian, they all have the same money to work with. So you're going to typically see the benefits be about fairly similar. You can see it, obviously, Securian's got a little bit lower death benefit, but all in all, pretty close. What are we offering? What's new about MoneyGuard? Rob, I've looked at MoneyGuard in the past. One of the things it's the standard in the industry, but I want to have the flexibility to have a daughter or my wife take care of me or a spouse. This is new with MoneyGuard. Now we give clients the option to get up to 50% of their monthly benefit in cash. Even if a wife or a spouse or a son or daughter is providing care, a neighbor, whoever it is, it just needs to be part of the plan of care. Every LTC plan out there requires a plan of care. The nice part about that is if we're electing to have a family member provide care a few days a week, we still have the balance of the monthly benefit to reimburse if we had a home care agency come in. So it's not an either or. There is that flexibility. We're just not going to provide cash and reimburse a home care agency on the same day. But as long as they're separate days, you have that flexibility. This is new with MoneyGuard. Last July, we had rolled out the ability to get 1/3 of your benefit. Now we've enhanced that to half of your monthly benefit. What else are we offering? All of these policies, you saw the benefits were fairly similar day one. I think what Lincoln does really well is provide robust options and benefits at the time of claim, or even now after claim. We want to give folks, that beneficiary, more options on what to do with that unused death benefit. Most of the policies out there, the Nationwides, the Securians, the Lincolns, these are individual policies, which is nice because you have the flexibility of building more robust benefits for her, less for him. You have the ability to tailor that. They don't need to have the same benefits. And the other nice part is you have 2 individual death benefits. So if the husband passed away first, that beneficiary now has that influx of cash to help pay for his or her care. What we want to do with benefit transfer is give that beneficiary the option on what to do with that death benefit. Up until this point, the only option was to take the death benefit. we thought, what if we give that beneficiary the option to maybe take a portion of that death benefit and roll it back into their policy, and Lincoln leveraged those dollars. And we did that all with no underwriting, even if that beneficiary was already on claim. So here's what we've done with benefit transfer rider. That beneficiary, as long as there's at least $25,000 of death benefit remaining, will now have three options. They could still take the death benefit they want. They could use that unused death benefit and roll it back into their policy, enhance their own benefits, or they could do a little of both. They could say, you know what, there's a $100,000 death benefit. I like 30,000 of that today, maybe to pay for the funeral or other costs, maybe make some modifications to their home. But I'd like to take the balance and get more long-term care benefits. And what's nice is those dollars come over and we're going to leverage those. And let's look at what happens. So what we're going to do is we're not only going to increase their total pool of dollars in their own policy, but we're going to increase their death benefit. We're going to leverage those dollars for a death benefit, and we're going to increase their duration. Here's the nice part. There's no additional underwriting. So that means that surviving spouse could be 85, already on claim, have Alzheimer's. And Lincoln's going to give them the opportunity to get more long-term care benefits at no extra cost with no underwriting. They also don't need to decide what they're going to do today. I don't have a crystal ball. They don't have a crystal ball. Let's decide at that time what we want to do. In fact, on the application, we're not even asking about benefit transfer rider, what they want to do. Every person's situation may be unique at that time, and they can decide at that point. The other nice part of this is not limited to spouses. I could have my mom buy MoneyGuard, and then my brother and I elect to buy MoneyGuard down the road. Assuming we're beneficiaries on my mom's policy, when she dies and there's at least $25,000 of death benefit, we each have the decision. Now, we didn't buy a joint policy, but I could elect to take my portion of her death benefit, roll it back into mine. My brother could say, you know what, I want that death benefit today. So there is that flexibility. The other nice part is most folks choose to get an inflation rider. We talked about a 3% compound. So that first piggy bank we looked at, that piggy bank's growing. We saw that 100,000 go to 700,000. That's because there was an inflation rider. When we move this money into their own policy, that new total amount compounds. So we look at an example here. Here's an individual that had been having a total LTC benefit, compounding. We're fast forwarding to age 80, but it's compounding by 3% every year. They had put 100,000 into their own policy, so their death benefit was 100,000. And as we talked about, they had a 70% ROP. Their spouse passed away at age 85. They elected to say, you know what, I want more. I don't need those dollars today. I'd rather move that into my own policy. So what we're going to do is we're going to take that $70,000 surrender value. Now it becomes 158. So we increase their surrender value. We took their death benefit. They already had 100,000. They moved 100,000 into their policy. We leveraged that another in 7 to 8% typically. So now they have a $208,000 death benefit. Essentially, we allowed them to go from 2 individual policies to a second to die policy. And then that they had 521,000 of LTC benefits. We moved over 100,000. Now they have 690,000 of LTC, and that 690 is compounding. So if we fast forward, Mary said, you know what, I want to move that into my policy. I'm concerned about my health. Now that I'm a widower or a widow, I'd rather have more long-term care. So without benefit transfer at age 85, she would have had 537,000 of LTC benefits, a 6-year benefit period, and 100,000. Now instead, at age 85, she has 690,000. We increased her duration, so she went from 72 months to 90 months, and her death benefit went from 100 to 208. So we increased her total pool of dollars by 30%. She didn't lose out on those dollars to the death benefit. It was still available for her. What else makes Lincoln unique? This is the one really big one, and we didn't tweak this at all with the new policy. Rod talked about the with Medicare, 100 days. We know that first 20 days, there's a lot of hoops to jump through, but if you have it covered, first 20 days is covered, but then days 21 through 100, that deductible is $185.50. With MoneyGuard, there is no deductible. For those of you that have written long-term care in the past, you know, most policies out there might have a 60 or a 90-day elimination period. If we think about that cost of care being $5,000 to $10,000 a month today, average, let's say it's 20 to 25 years from now, what's that cost of care going to be? This chart down below assumes only a 3% annual growth in those costs. I was in an assisted living facility last week in Indiana, and each of the last 3 years, their cost of care has gone up 10, 10, and 11% each of the last 3 years. So if we look at these costs of care, when you think about a 90-day elimination period, that's anywhere between a $35,000 and $66,000 out of pocket if you have a 90-day elimination period. That's assuming only a 3% increase. We know that's likely to be much higher. With MoneyGuard, there is no deductible. So once they qualify for benefits, those benefits are all available. Nursing home, assisted living, home care, adult daycare, hospice care, all available day one. That makes Lincoln, we looked at those numbers, right? The benefits were all about the same, but we didn't take into account that there is no deductible with Lincoln. How do we make this easy? We've been doing it for 34 years. 19 years ago, we stopped ordering medical records. We stopped doing paramed exams. We had enough of a claims history where we knew we could get enough of that health information from the client, typically over the phone. That's still an option, but now we've kind of moved into the 21st century. We're now giving everybody the opportunity to answer those personal health questions online, at home, on their own schedule, on their phone, on their iPad, on their computer. They can elect to do that, those health questions, whenever they want in the process. Submit to place those folks that are doing an online PHI versus getting on the phone with us for an hour. On average, we're seeing about a 10-day reduction in total turnaround time, submit to place, for those folks that do an online PHI. If they're 61 and older, and each carrier does this at different ages, they're typically around 60. We do it at 61 and older. We'll do a 15-minute follow-up phone call just for that cognitive screen. And then once we have all the information gathered, our goal is to make a decision within 5 business days. So this isn't something you're waiting for, like what's happening. Once we have that health information, we're going to make a decision. Right now, I get an update every morning at 8 o'clock. We're right between 2 and 3 days in terms of total turnaround time. What does it look like? My client gets a lot of spam. I'm a little nervous about having them complete this online. Is it clear? Yeah, this is exactly what the email looks like. Welcome to Lincoln Financial Group. We received your signed MoneyGuard application. We let them know that they have 10 days to complete it from that specific date. It's laid out in the email. If they have questions, they can contact us. They can just hit start. They'll verify who they are, last 4 of their social, they'll consent. Then we'll let them know what to expect. Hey, application process takes on this health information typically about 20 minutes. If they have no activity for 40 minutes, we automatically log them out. The nice part about this is they can start and stop. So I can answer the first 10 health questions, pause, and come back and finish it days later. It's really, really simple. I did one for myself the other day. It took 18 minutes, and I have a fairly complicated medical history. So it's nice to be able to start and stop and just move through that. And they'll verify who they are. And then almost like a pizza tracker, if you've ordered pizza from any of the, Domino's or whoever, you can see where you're at in the process. Same thing here. They'll be able to move through, answer those questions. They can save and exit if they want. And they can also, here's what's nice, print off a PDF. So rather than being on the phone with someone doing a health history interview, personal history interview, and it's a he said, she said, I didn't say that, they can print off a PDF of their answers, and everybody knows exactly how it was answered, and they can save that. 2 slides left. Last one, second to last one. Here's what resources. Rob, this sounds great. How do I find the resources that I need outside of working hours? Now, USAdvisors is unbelievable at providing all the tools that you need for every carrier. We wanted to provide a resource called our resource library, available 24 hours a day with no login. So if you need brochure, sales tools, you need like to do a campaign, we have campaigns in a box. So if you're looking to do a social media campaign or an email campaign, our underwriting tools, our information on our Lincoln Concierge Care, our claim, or if you're looking to do a presentation, they're all available with no login. So lfg.com/launchpad. The last thing I want to touch on here is really just to complement what Rod was saying. We're seeing great success in the utilization of this form. You're going to find this form on this website. This is called our asset identifier, and you're welcome to use this one to make it your own. But I consistently get feedback from advisors what they like about this. When Rod and I started in this business many, many years ago, and we had more hair and fewer grays, there used to be forms with someone presented long-term care. It was a hold harmless letter or a long-term care waiver, and an advisor, an agent, insurance agent presented long-term care. And then if you decided not to sign up, you had to sign this form. Listen, I presented long-term care. We wanted to take a different route on this. And our route was to make sure that everybody had a plan to fund it if they needed long-term care. Regardless if they bought MoneyGuard or another type of solution, there are going to be folks that say, you know what, I want to self-fund this. I'm okay taking on that risk. But what's important is that everybody knows what the costs are in their area, and we've identified which assets we're going to use. So this form's right on there, and I zoomed in on the next screen and just says, as part of the ongoing financial process, Rod, Crandall, and I have reviewed the risks of a life-changing event, such as an extended need for care. The estimated cost of care are, so we make sure everybody knows what it is for nursing home, assisted living, home care. We're going to also identify what resource we use to find that. And then what we're going to do, and again, this is an easy, non-threatening one-pager. You inform me you want to self-insure against extended healthcare. And we're going to use the following assets. We're going to, in writing, put down which account, name, type, value, and number. If I were to need extended care, if mom or dad were to fall and they were to need long-term care, which assets are we using first to pay for that? So if the kids call and they say, mom just went into a nursing home, she had a fall over the weekend. One, does she have long-term care? She may not, and you can say, we had a discussion about that, but you know what, we have a plan to fund it because I know it's expensive. In fact, here we looked at this on our last annual review. We've already identified which assets we want to use. We're going to just sign and date this. What I like about this is a great tool to utilize on annual review. So if we're meeting again next year, hey, last year we talked about long-term care planning. You indicated you want to self-fund that. And at that time, we had identified assets. Are these still the ones you want to use? This is a great opportunity. Maybe find out about money that you didn't know about previously, but maybe they might say, hey, you know what? That's right. We identified those 3 accounts. We actually liquidated that one to buy the cabin in northern Wisconsin. We might need to update this. Or they could say, you know what? That's right. You talked to us about that nursing home insurance. That's what I hear all the time. Nursing home insurance. Can we still get that, or is it too late? Bob's mom just went into a facility and they're charging $11,000 a month. Can we still get this? So this is an easy, non-threatening way to bring that discussion back up and just see if it's something they want to revisit. Rod, that's where I'm at, and I appreciate the opportunity to visit with all of you today.
That's beautiful. No, I really appreciate it, Rob. Thank you so much. I hope you guys see that, Lincoln, they're great partners of ours, and Rob's a great partner of ours. And I like to think that insurance companies end up leapfrogging themselves. That's what I've witnessed over 20 years. And right now, Lincoln has leapfrogged. And if you're not aware of what this looks like for your client, give them a shot on your next case and reach out to me or Andrew or George. Really love your material as well. And the fact that you can get at it without a password is a big deal.
Yeah.
And I do like that asset identifier. And I've used something similar in the past, and you mentioned it, but you're going to identify outside assets if you pull out that sort of that you pull out that sheet. You're going to find assets that you might not have under management. So in the last 10 minutes, I want to share a couple other resources we have at US Advisors that might be helpful to you. If you like any of these, you can reach out to any one of us and we'll be able to provide that for you. And then I want to let you know when our next Coach's Corner is going to be. So we'll wrap up in about 10 minutes. I'm going to go ahead and share up my screen for the other resources that I have here. And we will go from there. All right. So this is our creating your written plan of care. So this is a really nice sheet that I suggest you either send out to your clients ahead of a meeting coming in, or maybe use it as the agenda for the meeting. It's very simple, but it's very intuitive and gets people thinking. So often I say, I don't know exactly what you should do, but I think I know how you ought to be thinking about this, right? And so this should mirror what you've heard us talk about here in the last 50 minutes or so. Starts with experience. What experience, if any, have you had with family or friends needing care? I always want to start there because it's a dramatically different conversation if somebody has had experience and someone who didn't. Do you believe you could live into your 80s, 90s, or longer? Well, if they don't believe so, there probably isn't much of a long-term care conversation to have if they believe that they're going to die at age 60, for example. Right? Then it moves into, hey, you may never require care, but if you did, how do you think providing care would affect your family emotionally? What about physically? How about financially, right? Get these people thinking, right? And then ultimately, where would you want to receive the care as we talked about? Do you want that to be at home? Do you want to be somewhere else? Have you given that much thought, right? Who do you want to physically provide that care and who do you want to coordinate that care, right? By the way, a lot of times this is an opportunity to perhaps get introduced to their family members, right? Because a lot of times the people that provide the care, coordinate the care are family members. And a lot of times those family members are beneficiaries. And sometimes we don't have a good relationship with our beneficiaries and we might lose the dollars upon death. Well, this would be a wonderful opportunity to be talking to those beneficiaries. Plus, what you'll find is a lot of people wait too long to have this conversation. And they're 73 and they have health concerns. And maybe they can't get it, or maybe it costs too much. Well, do you think it makes sense for me to talk to your 50-year-old daughter? Because maybe if she has a little bit of a head start, we may be able to put her in a position of advantage, right? And so this can be a really nice talk track, if you will. And again, I know some advisors that are sending this out ahead of a meeting to get the clients thinking before the meeting. So if you like this, reach out to us and we'll grab it for you. We have another piece that we put together at US Advisors, which I consider to be just an executive snapshot, if you will. We've named it Navigating Long-Term Care, but it's effectively a 2-page PDF that just indicates, what is long-term care and what options do I have to receive care, right? We got home health care, assisted living, nursing home, et cetera. And then explaining long-term care a little bit. There's 3 main types of long-term care insurance. That's the standalone, and we have asset-based and life insurance and long-term care, right? It goes in and describes the difference between reimbursement and cash indemnity, right? You heard here today that the Lincoln MoneyGuard is flexible and can provide for both, right? It's important to understand that you have moving parts, right? It's sometimes hard to compare apples to apples contracts. We have to understand what these things mean. We have benefit amounts and periods and elimination periods, et cetera. What role does Medicare or Medicaid play? Just on a very quick snapshot basis, and what does it cost? So I find this to be a pretty good generic piece, if you will, that could be a good leave behind. I view this as a nice leave behind. Okay. Could also send it ahead of time, right? If you sent those first two pieces ahead of time and they actually read through them, they would have a basis for the conversation that you were going to have with them. Okay. I'm going to jump to this last one. We do have a piece on how does Medicare work, right? I told you that we largely ignore that for the purpose of our conversation today in this training. but clients are confused about it, often do want to know how Medicare works. And this is a nice 4-pager that walks through what that looks like. And it breaks out the different parts, part A, B, and D, and then Medigap. And then it goes through what they call the ABCs of Medicare. And so again, this is a nice piece that can be left behind or sent to them. It could just be a nice supporting piece to answer any questions that you might have. Right. So again, that's a 4-page piece that that we've had advisors take advantage of. Okay. Nationwide, with thanks to Rob, he's got great stuff. We have other carriers, as you're aware, and Nationwide has a really great white paper, I believe, with 6 tips to have a better long-term care conversation. This lady, Sean Britt, is an attorney that works directly for Nationwide. She does a lot of speaking. I've heard her talk a number of times, and I think that she has a real good authority on this. And there's a 4-page white paper that she put together with some tips that may be beneficial to you as well. So if you like this page, we can certainly provide this to you. Then the last piece to show up is something that State Life put together. Now this is the biggest, most robust. It is a consumer brochure. It is 16 pages long, talking about the myths of long-term care. And so again, this can be a nice piece. I happen to believe this saying that you take what you like and drop what you don't. So hopefully in hearing Rob and I talk today, you took some notes, and hopefully you have some tips, and there's some things that maybe we said that you did like. Maybe there's things we said that you didn't like. That's okay. Okay. The words that I use and the words that Rob uses are over 20 years of taking what we liked and dropping what we didn't. Words do matter. Okay. And it isn't always what you say, it's how you say it. And relative to insurance, it has to be directed towards the plan and what the insurance does, not necessarily what the insurance is. What insurance is messy. It's contractually driven. I have to talk to an insurance agent. The insurance company might want to deny my claim. There's a lot of reasons to not like what insurance is. But when we focus on what it does, and what it really does is it fulfills our promises to our loved ones. That's really what it does. And it does that through securing the financial plan, securing the legacy plan, and answering the what ifs. At the very end of the day, our clients do not need insurance in any form or fashion. What they need are answers to their most important planning items. And when they're working with you, the wealth advisor, that's exactly what they're coming to expect from you is, what do I need to know? What do I need to be thinking about? How do I need to be talking about this? So with that, I hope that this was beneficial to you. At the very end of the day, as I mentioned, we do these Coaches Corners once per month. Our next Coaches Corner is set for September 15th at 1 o'clock. We do have a financial planning advisors toolbox that has all of our best stuff, including the material I just sent you. We have scripts. We have a lot of recordings in there, different webinars, other white papers. So to the extent that you want that resource, again, please reach out to us. I'm going to go ahead and put up some contact information on the screen for George and Andrew and myself. But while I do that, Rob, I'm going to throw it back to you to see if you have any last minute comments for this group as I display George, Andrew, and my contact info here for follow-up. Rob?
Right. No, I just wanted to chime in say thank you for everybody for tuning in, but utilize these materials. Man, the piece that Nationwide put together, and that's obviously a competitor of ours, Sean Britt, is amazing. And I think the tools that she's offering there are great. One America, the Medicare piece. In fact, I had Rod send that to me earlier today. Save these pieces, lean on my friends, George and Rod and Andrew, because they're going to help you walk through that and help you from A to Z. So I'm thankful for a partner like them and appreciate the time today.
Beautiful. And we're thankful for you too, Rob. So with that, we hope everyone has a successful day. I'm going to end this call like I end my Monday morning sales meetings. And those are, let's do the right thing for the client. Let's be good leaders, and let's drive revenue for our firm. And that's the beautiful thing about our business. We help people get what they want. We ultimately get what we want. At the end of the day, that allows us to do the right thing for clients. It drives additional revenue to our practices. It keeps competition away. It protects us from liability, demonstrates fiduciary capacity. And at US Advisors, we're here to help you intentionally do this type of business. So please reach out to us on your next case, and we're happy to help you. One more thank you to Rob and Lincoln MoneyGuard, and you guys have a wonderful day, okay?
Thank you.
Take care, everyone.